You are planning to move to France and intend to purchase a business when you arrive in the country in order to take over an already established activity, ensuring both income and stable lifestyle. The valuation of the company is high and you would like to take out a loan to partially finance the purchase of the company's shares. In this video, here are 2 reasons why you should not purchase the French company in your own name as a private individual. 1. The financial loan will generate interests that you will not be able to deduct personally. The loan you take out to buy the shares will generate interests. However, you will not be able to deduct these interests from your personal tax return at the end of the year because you purchased the company as an individual. French rule. Example. In the company you acquired in France, the previous manager's net remuneration was 100,000 euros per year. And let's say you would like to keep the same level of remuneration. In France, if you are single, you would pay approximately 20,700 euros in tax return at the end of the year, based on the 100,000 euros net remuneration. However, if during the same year you paid 10,000 euros in interest on the loan used to acquire the shares of the company, you will not be able to deduct those 10,000 euros from the tax you owe. The total cost of this acquisition therefore becomes particularly high, because you are paying 20,700 euros in tax return plus the 10,000 euros in interest. You can do better in France by setting up an acquisition holding company, which would allow you to deduct from your taxes the interests on the loan. 2. Dividends from the company you bought that are used to repay the loan are immediately taxed if you bought the shares as an individual. You may be relying on the company to pay you dividends so that you can gradually repay the loan taken out in your personal name. However, you should know that in France, if you pay yourself dividends, you must immediately pay a 30% tax on the dividend amount. So if you plan to receive 50,000 euros in dividends from the company and then use that money to repay the loan, here is how the transaction will work if you took out the loan as an individual. 1. The company must distribute 50,000 euros in dividends, but first it must collect the 30% tax on that amount and send it to the tax authorities. But 30% of 50,000 euros is 15,000 euros. As a result, the company will actually pay you 50,000 euros minus 15,000 euros in taxes, which equals 35,000 euros. Of course, these 15,000 euros are taxes paid in addition to the 20,700 euros tax return already paid and discussed in the previous example. Remember, the one calculated on your 100,000 euros annual remuneration you paid yourself? See previous example. 2. You then use these 35,000 euros net dividends to repay the loan taken out in your personal name. Once again, you can do better and avoid paying this 30% dividend tax by setting up an acquisition holding company at the time you purchase the company.